All right, let's dive in. Today, we're looking at a story that, honestly, most people probably missed. It's about a quiet move from one of the world's most cautious investors, but it sends a huge signal about what was once considered the safest asset on the planet. And this isn't just about bonds. It's really about the foundation of the entire global financial system.
So this is really the core question we need to answer. I mean, on the surface, who cares about one Swedish pension fund, right? It sounds like a pretty niche financial story, easy to just brush aside. But when you start to unpack it, you realize it's telling a much bigger story about risk, about trust, and maybe even about the future of how money moves around the world. So, let's set the scene. Our story starts not with some dramatic market crash, but with a very quiet, very deliberate decision made by Alecta. Now, Alecta is Sweden's largest private pension fund, and you have to understand their entire reason for existing is to avoid risk for millions of people's retirement money. That's precisely why what they did is so important.
So what did they do? Well, over a few months, they methodically sold off almost all of their U.S. government bonds. We're talking 70 to 80% of their holdings. This was no panic sell. It wasn't a fire sale. It was a cold, calculated, strategic withdrawal from the one asset that everyone has always called the bedrock of global finance.
Okay, so that leads to the obvious question. Why? Why would an investor whose entire model is built on long-term safety and avoiding risk make such a dramatic shift? Well, the good news is we don't really have to guess. Alecta's chief investment officer, a guy named Pablo Berningo, was incredibly direct about their thinking.
I mean, you can't get much clearer than that. He didn't hide behind financial jargon. The fund's own investment chief pointed right at the fundamental fiscal health of the United States. They basically looked at the numbers, looked at the trajectory, and decided the risk-reward calculation just doesn't work for them anymore.
And when you dig in, their reasoning really boils down to three core pillars. It wasn't just one thing. It was this convergence of concerns. First, the obvious one, the sheer size and growth of U.S. debt. Second, what they see as rising political risk and policy unpredictability. And third, maybe the most profound of all, a growing doubt about the long-term stability of the U.S. dollar itself.
And just to put some scale on that first point, this is the number that's causing concern. The U.S. national debt has just exploded to over $38 trillion. Now, if your job is to guarantee pension payments decades into the future, a national debt that's growing way faster than the underlying economy, well, that's not just a concern, that's a massive red flag.
So, how did the market react to this news? This is where the story gets really fascinating because we saw two totally different, almost contradictory reactions play out at the same time. The bond market and the stock market told completely opposing stories.
First, you have the US Treasury market itself. It's a $30 trillion behemoth, and honestly, it barely even blinked. As you can see here, the yield on the 10-year bond, it actually went down a tiny fraction. This just goes to show you how incredibly deep that market is. It can absorb a $9 billion sale without breaking a sweat. But at the exact same time, you have the stock market. And this chart really illustrates the paradox. While the bond traders were calm, Wall Street heard the news and reacted fast. The S&P 500 had its worst single-day drop in months. So, what was the stock market seeing that the bond market wasn't? And here's the answer. The stock market wasn't panicking about the volume of the sale. $9 billion is, frankly, a drop in the bucket for the Treasury market. No, it was reacting to the signal. It was reacting to the who. This was a vote of no confidence from the exact kind of stable, conservative, global investor whose trust the United States has, for decades, completely taken for granted.
So, this leads us to the next logical question. If you're a giant pension fund and you're selling off your U.S. debt, you've got to put that capital somewhere else, right? And the answer to where it went starts to sketch out a new map of what's considered safe in the world.
Most of the funds were moved into German government bonds, what they call bunds. Now look closely at this trade-off, because this is the really telling part. Alecta willingly gave up almost 2% in annual yield to make this move. Think about that. They consciously chose to accept a much lower return on their money in exchange for what they now see as greater stability and lower risk in Europe.
What we're seeing here is a textbook example of a rising risk premium. For decades, U.S. debt was basically the global definition of a risk-free asset. This move is a signal that for some of the world's most cautious money managers, that's just not a given anymore. They are now, in effect, demanding a higher return to compensate for what they perceive as growing risks in the U.S. system.
So let's step back and put all these pieces together. What's the big takeaway here? It's really important to be clear. This is not about an impending market crash.
It's not about the dollar collapsing tomorrow. The signal is something much more subtle and much more structural than that.
Now, to be fair and balanced, we do have to consider some other technical factors. Some analysts will point out this could just be smart asset liability management, matching their future pension payouts in euros with assets also in euros. Or it could be about the rising cost of hedging against currency fluctuations, and those are all valid, non-political reasons for a fund like Alecta to make this kind of move.
But even with those caveats, the overwhelming interpretation in global financial circles is that this is a warning shot. It's not a cannonball that sinks the ship, but it's a very clear signal. A signal about the slow, steady erosion of the unquestioned trust that has been the foundation of U.S. financial dominance for generations.
And that really leaves us with the ultimate question, doesn't it? For our entire lifetimes, the global financial system has operated on one core assumption: the fundamental stability of the United States. And Alecta's quiet $9 billion move is a sign that this foundational assumption might just be starting to crack. And the questions being raised by that single crack, well, they might just be the most important signal of all.